the Real Estate Players Podcast. Real talk, real players.
Welcome back. Joe Pizzurro here with James Wilson and today's guest, Rick Crain, Jr., Commercial Risk Advisor. Hi, Rick.
Hey, how's it going, guys?
Good.
Doing good.
You ready to talk
We're
a little
excited.
commercial insurance?
Yes. Yeah. Please tell us, give us an update. We've been, as we're getting toward the end of the year, looking, toward January and Q1, and what's the commercial, insurance market looking like right now?
Yeah, good question. So for commercial real estate owners, specifically multifamily owners, the market is getting better on the property side, which is a really nice sign for owners, investors, managers, equity partners, you name it. So I'll back up a little bit. From 2013 to 2019, it was a pretty soft market where folks were getting really favorable property insurance rates on their commercial holdings. And you could put a lot of different properties together on master policies. It didn't matter if they were like, kind, and quality. It was a little bit of a Wild West in a good way for owners. But once we hit 2019, we started to hit a hard market, and that lasted through the end of last year, 2024. And a couple key reasons why that is the case. Number one was the pandemic, right? You had a situation where there was labor shortages in the building markets. There was supply chain issues. So when you think about cost of construction or cost of reconstruction, those skyrocketed. So it made the claims values much higher than what they were. Secondarily, you had issues with how capital is deployed into the insurance market. And a lot of that is predicated on billion-dollar catastrophic losses. So for the last 20 years, 12 of the most severe catastrophic weather years in our country's history were 12 of the last 20 years, that was the case. So you saw huge losses mounting, and what that did was, again, drive up claims and decrease profitability for the carriers. So then it becomes a simple economic situation. Supply and demand is when carriers are not doing well, they'll exit the market. Capital that's deployed to help increase capacity leaves the market. And then we were building a lot. So you had a lot higher demand for insurance, but a much smaller supply. So it's really economics 101. But happy to report here in 2025, the market has softened quite a bit. And just a couple of stats on why is that the case? Well, in 2023, there was a $21 billion profit loss in the property insurance market. In 2024, there was about a $25 billion profit gain in the profit insurance market. So obviously prices are lagging after you see fluctuations in losses and gains. So carriers were making a lot more money. Their loss ratios were much improved. Second was investment income into the insurance markets went through the roof in 2024. About almost $80 billion of new money came into the insurance and reinsurance markets. That's a 20% increase year over year. So again, we now have more supply of insurance with the same or less demand. So that compressed rates. And then you're also seeing alternate capital. So there are large investment groups investing in cat bonds to the tune of 50 billion. And then insurance-linked securities, there was an increase of $115 billion of capital infused into the market. So when that happens, it creates more competition. Carriers come in and they want to compete. So a lot of incumbent carriers are then doing a lot to decrease their rate per hundred in property values in terms of how they derive their pricing to help retain renewals. They're fighting for their renewals, and new entrants are coming in and taking business away. So that's good for owners and insureds that have commercial property. On average, we're seeing around a 10 to 25% decrease depending on the asset kind and quality. And in really large programs where they're shared and layered and you have multiple carriers participating in a tower of property insurance, we're seeing upwards of 40% savings in some of those instances. So it's really
Wow.
favorable.
Yeah, it's interesting to hear. So what can someone expect when they're, getting an acquisition? I guess you said renewals as well. People will get better rates, so the current carriers have to compete. And you said what, 10 to 20% price decreases?
Right. Yeah, that's certainly the case. So, yeah, when groups are looking to acquire new assets, it's really important to take a look at the deal desk and have a trusted advisor that, checks the work of whatever's been provided within the insurance indication from the seller, because the market shifted so fast. Let's say the seller placed their insurance policy in February or March of this year, and you're looking at a deal here in November. Those prices from 6, 9 months ago are not accurate. So that's where you want somebody to take a look at it and say, today and now, because the market is changing so rapidly, what can we expect on a cost per door in a multifamily perspective and cost per TIV in some of your office, industrial, retail lines of business?
Yeah, I was going to ask about, a lot of multifamily owners look at cost per door, and those were above 1,000 a door, a year ago. And, I guess it depends, right, on the property condition and the location. But what we're seeing now, maybe 600 a door, 700 for like B and C.
Yeah, I mean, you're getting to like Class A and B plus, you're probably looking at that 600-ish a door, and then B and C, you're looking at 7 to 750, sometimes 800, just depending
Okay.
on age, location. A lot of it has to do is it close to perils, wildfire, hurricane, wind, hail, things of that nature.
Is there a better metric to use than, per door, or is that typically, a good indicator?
It really is. I mean, we look at it both ways. Like the property premiums are the lion's share of the expense on that line item for owners. So we do like to compare property rate, which is the rate per every 100 in building valuation that you're seeing. So, it's interesting. Last year we were seeing stuff more in the 40 to 50 cent range on properties that are, call it 80s, 90s vintage and here in North Texas, and now we're seeing stuff down in the low 30s, and then for Class A, you're starting to get into the high 20 cent range, which is really, really nice.
That's a great update. I think people will be very excited to hear that instead of going over $1,000 a door, we're getting back down to, 6, 7, 800 a door, which seems a little bit more manageable for people operating these properties because we've just seen NOI decrease because of that and other factors, obviously. But yeah, thanks for that update. What can people expect when, looking at the insurance policy for their property? Like, what do you guys typically recommend as far as which coverages to get, and are there different coverages for different types of acquisitions?
Yeah, so primarily a lot of it's going to be dictated by the lender. So if you have debt on the property, the lender or the facility that's helping you source the debt will have requirements that you want to follow. And it really comes down to limits of insurance. Like what is the replacement cost per square foot that we need to insure to value on? And then from there, it's a decision of the owner is like, do I want to go at their limit or above based on my overall risk appetite? But usually their replacement cost per square foot is pretty reasonable. And it's interesting too, going back to a little bit of our conversation earlier, 5, 10 years ago, you could replace a wood frame garden style apartment for $80 a square foot. Now, carriers, a lot of them, their minimums are $125 a square foot. So that speaks to the increased cost of construction. But they're going to set that limit. They're also going to set the limit for the business income, which is your rental income. And you want to ensure the full value of the rents that you expect to receive in a 12-year period or 12-month period, sorry. And, some will also want to see endorsements for extended period of indemnity, which essentially means we're going to buy you an extra 3, 6, 9 months of business income. Because we know that sometimes projects, if something burns to the ground and we got to replace one of the buildings in a complex, it may take longer than expected. And then really what you're looking at there is the trade-off on the deductible structures. So, Fannie and Freddie are going to have more stringent requirements than some of the other groups out there. So, that was a big pain point the last 5 years in the market is here in North Texas, we are seeing wind hail deductibles at 5% of total insurable value, which is astronomical. Happy to report that we're starting to see things drop down into the 2% range, which is really nice. And, it's all about deal structure because, even you look at that percent deductible, that you have to have an advisor that really understands how the policy works and responds because you can have a deductible that applies to the total insurable value, maybe 20 million bucks, like 2% on 20 million is a big number. But if it's a percent deductible per building, then maybe if it's a $20 million project and you have 10 buildings all valued at 2 million, well, I'd rather take a 2% deductible on $2 million loss if that one building gets hit
Right.
versus on the whole thing. So there's a lot of devil in the details on how you can structure a policy to be advantageous from a compression standpoint, but also how do I protect my asset?
How do you get the per building? Is that negotiable or it just depends on the carrier?
Yeah, it depends on the carrier. It's certainly negotiable. The most important thing to do in a multi-building format is to have a very detailed SOV by building because the underwriter can write to the risk. If they just see one line item that says ABC Main Street and it's 20 million bucks and we have 5 buildings and 150,000 square feet, that's harder for them to wrap their head around than saying, okay, we've got 5 buildings at 2.5 million each, and they're all 15,000 square feet. And oh, by the way, each building is 45 feet or more away from each other. You think about fire risk jumping from one building to another, they can start to understand that, or like a hurricane or a tornado moving through, they can understand how we're not going to have a loss of all of those buildings when one of these events occurs. So having that detailed SOV that lists out all the buildings and then having a comprehensive picture of what's going on at those properties. I mean, oftentimes clients will come to us and the SOV that they have is 10 columns wide, where the ones we like to use are in excess of 30 columns. And it sounds daunting. We're good advisors are here to help you with that. But the more information you can provide to underwriters, the better your opportunity is to secure the most optimal coverage at the best pricing. And, leaving data out doesn't buy you any savings. It negatively impacts how they look at it. If they can't wrap their head around it and underwrite it to it, you'll get a little bit of a penalty into the rate that you get out the door.
Yeah, no, I think that's important for people to catch is what you just said, that the more effort you put in up front helps you in the long run. And I've seen your SOV template and it is a lot of columns, but to your point, that's a good thing.
Yeah, and the reality is good advisors are there to help you with that. And if you're going to have whatever your thesis is, if it's a 5-year hold, an 8-year hold, 10-year hold, like putting a little bit of sweat equity on the front end to get it right is going to help the cost compression across your NOI year over year. So putting the time in up front, I know most people's least favorite thing in the deal is the insurance, but lean on your advisor to help you with that. And when we work with groups, we always ask for current policies. We need to take a look at loss runs. We help them formulate their SOV. And a couple things that help there are property condition reports. So you get one of those, a lot of those details are inclusive of that report. So we can extract the data from there and fill in most of the details that we need to prove to the underwriters what the fire and life safety look like at the buildings, because it impacts both your property rate and your liability rates for, the bodily injury property damage to third parties where people living at these facilities. So the PCR is really huge. And another thing that's really important that goes underlooked by a lot of investors is CapEx. So even though work hasn't been done at a given property, like most of you guys are buying these for value add opportunities. Well, if you're going to go spend a couple $1 million rehabbing a property, we need to disclose that to the underwriters. They're going to know that they may give you a credit on your rating in year one because they know that the property is going to be up to current building standards. And then certainly in year two, once the project's done, you may get more rate compression thereafter. So sharing a CapEx report or summary of the type of things that are being done to the property is very, very helpful for underwriters and investors to share with their advisors.
Yeah, sounds like having a good advisor like yourself makes all the difference on these properties. What are some other mistakes that you see people making in the insurance world?
I think it's just one would be not knowing enough or not asking the right questions where you go lender to lender, right? The insurance that you're seeing from the seller group may be different than the requirements that you have to go get with the lender that you're utilizing to buy the deal. And well, one of the challenges we see there is on the liability side is there are now more stringent requirements from lenders on exclusions and sublimits to certain liability related events. One of the biggest ones is abuse and molestation. So a year ago, even, you were able to still get a loan from Fannie and Freddie with a sublimited abuse and molestation limit, maybe 100,000 per occurrence and 300,000 in the aggregate, or sometimes it was excluded entirely. Like we don't recommend that to our clients and our insureds, but sometimes you can't get the coverage because a crime score or other factor that the underwriter's looking at isn't very favorable. Well, now fast forward to 2025 and Fannie and Freddie said no more. Like you have to have full A and B limits to the policy max of 1 million occurrence and 2 million in the aggregate. And you may not know that when you look at a seller's insurance program. Do they have an exclusion there? And do they have, or a sublimit that's making their liability rate per door cheaper than what it's going to be when you buy the property? And then the other thing that you're going to see is what does the excess liability limits look like? So they may be insuring at a $5 million excess liability limit where your lender requires 10 or 15. Well, again, you think about an insurance tower, we may have to layer up with a couple carriers to get to that number. And every carriers have minimum earned premium or minimum premiums. So for every 5 million in limit they provide, it may cost 10, 20, 40 grand. So you just have to keep that in mind and make sure that you're asking the right questions and digging through the devil in the details before you fully underwrite a deal and then when you go to market.
Right. Yeah, we have time for maybe one more question. I wanted to ask also, as owning multiple properties, sometimes we think grouping them together is going to get us a better premium, but sometimes not. Maybe did you want to share a little bit about, when that's the right thing to do and when it's not?
Yeah, good question. So for us, we really look at the $100 million in total insurable value. That's when you start to get enough critical mass with the carriers where they will look at putting it on a master policy, for lack of a better term. That's kind of on the low end where there's enough volume and economies of scale where they can underwrite that risk. So that's really kind of the golden number that you're looking at on the low end. But then there's other factors that come into play is what does the spread of risk look like? Is everything clustered in a 5 mile radius, or do you have stuff in different cities and states and things like that? Because most of these property forms are written on a peril occurrence form, meaning any one occurrence of said peril, they look at a PML, a probable maximum loss, and they can model it. And that's what we do for clients as well is we'll again take that SOV of all the different properties that you have in your portfolio and model it through air modeling, wind modeling, fire modeling, earthquake modeling, you name it, and then we'll come up with losses. So that's the other thing that is a little bit of a misconception is just because you have 200 million in assets under management or ownership doesn't necessarily mean you're buying 200 million of insurance. I have a client that they started to do a lot more GP work lately, where traditionally they did a lot of LP work, and in the last 18 months have cobbled together 5 different properties, a couple here in DFW, one in Tennessee, 2 in North Carolina. They were about 140 million in total insurable value. Well, we ran modeling and we bought a $52 million loss limit. And that was able to save them 6 figures on the insurance spend versus having all of those on separate policies. But like we say in insurance on our side, everyone's favorite answer in insurance is it just depends. So a good advisor is going to look at it from all angles of do we have enough really good looking risks in here that can help with some of the risks that aren't as bad, or do we have to one off somebody where, yeah, that property may not fare so well on a cost per door basis, but by isolating that one outside of the program and keeping the others together, the benefit across the whole portfolio is much more impactful. But again, at the very end of the day, we know that NOI is king. So you got to make sure that it pencils no matter which way you do it.
All right, Rick. Thank you so much for today's conversation and joining our podcast. We'll close it out with how can our viewers and listeners get a hold of you or find out more about your services?
Yeah, that's a great question. You can go to swinglecollins.com, SWINGLECOLLINS.com. You can look me up. I'm an advisor on the roster there. You can email me directly, rcrain, RCRAIN at Swingle Collins, or hit me up on LinkedIn or give me a call. Joe, you have my number, James as well. But, more than happy to have a conversation with anybody that's just looking for advice. I mean, that's part of what we do is just have conversations with people and try and help them out. We're small business owners ourselves, and we want other small business owners to succeed and thrive in today's market. So thank you guys. Had a really, really good time. Very enjoyable conversation today.
Rick Crain Jr. Thanks, everyone.
Thanks.